Right, so a little bit about Charter Impact. We have been around since almost as long as Jason Watts. Established in 2010. We serve now. This is minor league. Yeah, it says 100 plus. We have a little over 130 schools that we serve. We are now in 6 states. Over 100 of those schools are California. We are primarily focused on California. Did anyone here use a back office provider? So back office provider is a way to like outsource your finance function because finance is so complex and business continuity is so important. Charter Impact has about 120 employees. So if we have one employee leave, we've lost 1% of our knowledge base. If you have one finance internal person leave, you might have lost 100% of your financial knowledge base. And so one of the key advantages there, but we do AP accounting, finance budgeting, payroll, and we do student data, SIS, CalPADS reporting. Yeah. And then Ben, a little bit about Omni.
Omni Bank was formed in 1984 in Los Angeles. Like I said, I've been in commercial banking for over 35 years, dating back to my days from Michigan. In 2015, Omni Bank started up in the charter school space. We had a couple of clients. We've expanded over the last 8 years up to over 30 clients. Initially, we were doing things like helping them through growth with loans, get through the period where you've got to hire all the people in the fall to take care of the new students, and the money doesn't come in until March or April. Eventually, you got to the point where they needed the PPP loans. Then there was the deferral period where we had to finance schools while California was deferring their, at least we've had clients that buy their real estate, ditch the landlord. In the past couple of years, as cash positions have improved, we've moved to a lot more focus on investing your funds and protecting your funds. As one of the things we'll talk about is the ICS protection for all of your funds that every bank should offer. If your bank's not offering it, you probably just need to talk to them about it. And thanks for having us today.
Yeah. Real quick, don't have a slide on it, but like, I think it's always important to sort of gauge who's in the room. Who here is a charter school leader? And then we have, I think, some vendors. Who's a vendor that's just also sort of learning a little bit? That's great. Who here is at a non-classroom based charter school? Anyone? Perfect. And then I assume everyone else then would be classroom based? Hybrid.
Yeah.
That's good too. We have a couple clients where it's like 2 schools. One is non-classroom and one is classroom. Which is a really nice model. And then who here owns their building? Who would want to own their building in the near term? Yeah. Who's currently borrowing cash? And then who currently has a pile of cash in their bank account? And keep your hands up if you're investing that cash, having that cash work for you. So definitely a good thing to do if you have the extra funds and the ability and the knowledge. So with that, so objectives, we're going to talk about, planning for today, but also saving for tomorrow, setting up your sort of cash management plan, understanding the rules of how you invest and earn, and then making sure that you are protecting those assets, whether it be cash or building or whatever sort of investments you're. So in the theme of pumping iron, we're going to be fiscally strong and sound. So proactive planning, establish financial safeguards to anticipate the challenges. Who here is creating that 5-year model, but actually doing it thoughtfully and in depth? You're thinking about like where you want to be 5 years from now, trying to anticipate the needs of your school, whether that means, hey, right now we're a single site school and we want to open our second school in 5 years. What are the steps we need to take now to make that a reality and a possibility, right? And that's just one example. Your reality might be very different. Maybe right now you run a single site school, 250 kids, and you just want to stay that single site school, 250 kids. There's a lot of competing factors around that, right? What are you doing to set yourself up for renewal? How are your testing scores? The thought of planning is not just the financial element, it's the academic element, it's the staffing element, it's all of those pieces together. And that's why you want to be very thoughtful and strategic in it, to have that 360 view of what am I doing today to set myself up for success in the future. Diversifying of revenue streams. So this might be a little bit interesting as a charter school, right? But if you're sitting on that pile of cash, can you invest it so you're getting a 4% return right now to help add the revenue stream? Or, it says revenue stream, but can we reduce our expenses almost like a new revenue stream? Can we buy our building to then not have to pay rent or pay rent to ourselves? Because that's a new revenue stream. We now have that. We are now taking ownership of it, right? On the cash flow side, who here is aware that we have deferrals in June? Is anyone? Yeah, they're really, really small. It's a 5% deferral of just the June apportionment. So if your June apportionment is $1 million, you're going to defer 50,000 of it, and they're just deferring it from June to July. So you'll probably get that check a week later. So it's not going to have a meaningful impact on your cash flow. But part of this is also the planning portion of what if the deferrals were worse? What if we have a recession? Ben brought up the deferrals in 2021. After the pandemic, the state deferred 35% of the LCFF revenue, not 35% 1 month, 35% of the entire pot. And so having that sort of banking relationship or forward thinking of what would we do in this emergency situation is very helpful. And, even if you don't need the line of credit now, knowing that you have a bank that understands the apportionment model, understands that giving you a line of credit is an investment in the state government, which if that fails, we're going to have bigger problems than just them getting their money back as well. But figuring out what those sort of opportunities are, figuring out how your reserves are being utilized in cash, in property, in assets, and in investment, and then strategic decision making and aligning the spending with what your goals are. And part of that also comes with having those conversations with the board of what are the long-term strategic goals, involving them in that strategic plan. I was just talking with a client about, they have an annual long-term strategy meeting where they set up those 3-year and 5-year goals and have a committee that does that to make sure that they're all in alignment. And part of that is being the forward thinking, this school wants to grow and be bigger. But again, every school should have their own internal goals. It could just be to maintain, but knowing that you are in alignment strategically internally, as well as with your board, is really important to that.
And one thing I remember from the past, it hasn't happened in a while, but the government in California used to have these budget delays. And month, 2 months, 3 months, and so having something in place if that ever were happen is
So
valuable as well. We hope that they've gotten over that problem, but a lot of us remember those days.
yeah, I mean, we're about to experience one at the federal level, right? If the Senate doesn't approve the gap measure. But Ben's talking about when the California Congress was more evenly divided. It would be really interesting if the 80% supermajority Democratic legislature in the state was unable to come up with an agreed upon budget, but you never know. Crazier things have happened. So, Jason, anything you want to add on?
Not sure.
All right. So, the role of reserves. So I touched on it a little bit. Everyone understands that your reserves are not cash. Probably the most common, it's often when I talk with boards, they think it's sort of 1 for 1. But let's say you own a $10 million, let's say you own $2 million of your building. Your reserve is your assets minus liabilities. So if you had a $2 million reserve, you own your $2 million building, your actual free cash in theory might be zero, because if you paid off all your liabilities, you would net to zero on your assets as well. So you're probably borrowing money in that situation. But the reserve that you want to build, it's going to act as your safety net. Um, you might be at a school that has a 50% reserve. Again, assets are a part of that, so it's not 50% as cash, but you want to build that so you have a safeguard for any sort of uncertainty, economic downturn, um, a lawsuit that is unforeseen, that is very expensive, although hopefully you have liability insurance and your actual liability would be much less. But you really have to build that reserve. You want to run a 3 to 5% surplus annually. So you're building this year over year in case you ever need to tap into that safety net that you have. And then it also enhances your credibility, right? By having a reserve, a bank is going to be more likely to give you that line of credit because they know that you are running a sustainable, reliable program. You're not overspending. You're not in the red every year. Yeah,
That 3 to 5%, that's 3 to 5% of what, total assets?
it's total expenses. So anytime you refer to the reserve percentage, how the CDE looks at it is the annual expenses that year.
Uh-huh.
So let's say you had $5 million in revenue and $4 million in expenses, which running a 20% surplus is typically not a good thing because often means you're not spending enough on your program. But the CDE or your authorizer would look at it basis that $4 million expense, not the revenue part.
You mentioned reserve, you mentioned percentage, but is it months? I'm reading it.
So the months there is talking about cash flow. So you would want to have like 3 months of cash flow. So that means you want to have 25% of your reserve in cash, right? 3 months being 1/4 of the year. So that's always a good operational practice, or have the access to tapping into cash, whether it's line of credit or that 3 to 6 months doesn't have to be sitting as free cash. It could be in a money market earning money for you, or you could own a building and then set up a line of credit against that asset, or there's always options there with it. Again, part of this strategic planning here is assessing what level of reserve you want to obtain to feel comfortable, and that's a conversation with the board as well. And then, especially if you are a non-classroom based charter school, which is more scrutinized under the funding determination, you want to set a reserve policy. Our goal is to have a 75% reserve balance, and we are setting aside 10% of that in case there is a large lawsuit that was unexpected. We're setting aside 25% of that for our cash flow day-to-day needs. We're setting aside 15% of that for economic uncertainty. If you need a templated reserve policy for your board, reach out. Sam's coming around. I'll be happy to provide you. We have a template that we use with clients, and that gets things going. But figuring out that designation, again, when you do the funding determination, if you are non-classroom based, the CDE will question any fund balance that's greater than like 30%. Classroom-based programs are fortunate; they don't get questioned. They don't have to submit something like that. But very important that you understand what the clear goals are and why you're building this sustainable program.
Yeah, so you would be surprised at the authorizers not understanding how you actually spend into your reserves. So it's not like you have a savings account that you can pull from whenever you want. You have to deficit spend to get into that reserve allocation. So we have pretty strong reserves for all of our school sites. And more than one of our authorizers has asked us, what is your plan to spend that money? You have all this money, needs to be going to kids, et cetera. But in conversations with them, I was surprised that they did not understand that we can't just pull money from those reserves to spend on whatever we decide to spend it on. So the key there is you'd have to get your authorizer to not only understand this, but then to essentially agree that you're going to deficit spend in any given year for whatever the cause is. Maybe you're doing facility acquisition or upgrades or some major purchase for school site, curriculum, or whatever the case may be. But if they don't understand this, then they may freak out, like, what's going on? Now you're going beneath the 3 to 5% threshold. Well, you asked me to spend the money. This is how it's done. So I was surprised that they did not understand that's how it works. So if you get to that position, if you haven't been there yet, just make sure you have really good communication with the authorizer in that regard.
Thanks, Jason. Yeah, everyone understands that. Yeah, the reserve is built by having a surplus. The reserve is depleted by having a deficit. And, districts are a little bit different, to Jason's point. So all charter schools here function in Fund 62. Very, very standard, something that like flies under the radar. Districts operate in multi-funds. So like if they have a surplus, they can move the fund into like a transportation fund because they're going to buy some buses. We can't transfer the funds into like specific other budgets. All of your funds sit together in that one bucket, and the only way to spend it is deficit spending. So, thanks, Jason. All right, so establishing that reserve policy just a little bit more in depth is, defining the purpose. Why do we need this? What are we using it for? What are the things that we are uncertain about? Are you worried that, that there's a pending litigation or lawsuit, and that you might need to use part of that as a deficit because you don't want to have the programmatic issues or declining your program to spend it. Set those targets. So whatever that number is, we want to have 3 months of free cash flow available to us. And part of that is in the fund balance. The other element here, just sort of elongating or going back to Jason's point, part of the conversation we'll have with the scholarship prep authorizers is like, hey, they have a 50% fund balance, but 35% of that is the assets that they own. It is not free cash. It's not as though they can liquidate this building that they're currently using. Like reminding them that reserve balance, fund balance, using them interchangeably is not a cash balance. Provide that guidance of when it can be used. So if the board approves a 50% reserve balance goal, then maybe it is that you start deficit spending once you get above that 50%. But then what else comes into play of like scholarship prep has bonds. They need to have those conversations if they're going to deficit spend because they'll break their covenants. Or Ben's clients have lines of credit. They're going to break the covenants on the lines of credit. So understanding what needs to take place and what the downstream effects of that could be. And then, figuring out and refining that plan over time to equalize with where you want to be because your goals are going to fluctuate and change. All right, so strategies to use that extra cash. Strengthen the reserves, right? Strengthen that resolve, strengthen your ability to handle the curveball that will inevitably come at your school. Invest in the growth. So here is sort of going back to that long-term planning. Right now, we're a K through 6. Maybe we want to add 7th and 8th. Investing isn't necessarily just like putting your money into a money market account or buying a building, right? It's also figuring out the sustainability and investing in your program, in your staff, in your technology. Can you renovate a classroom? Can you make your science lab that much better? Is that going to set you apart? Part of this is also the elevator pitch that you would give to prospective parents and students. What differentiates your school from the charter school half a mile away or from the district school a quarter mile away? And part of that is investing in the facility, in the staff, in the program, not just investing your money, right? Not just that banking, but real quick, if I see a lot of people taking photos, these are posted, should be posted to the CCSA in the program guide. If they're not, I will check in with them, but I did upload them. Oh, they're there? Okay, great. I got a thumbs up. So, but feel free, you can take photos. Just wanted to let everyone know that they're available as well. And then, debt reduction. So if you currently owe money on a facility or you have that line of credit and you owe a balance, do you want to pay that down or strategically are you keeping it as cash flow? Was it last year scholarship prep had like $2 million extra and we chose to pay down part of their bond to save the interest costs. It's a 30-year bond and we still chose that the interest rate paid on that bond, 7% or so, was better than earning 4% currently in the market. And we paid off the final 2 years of the bond. So it's the interest that would have compounded the longest. So the savings are pretty material. I think we paid down $2 million and it saved like $1.1 million in interest. So figuring out that strategic plan of what are your current liabilities, can any of that be improved instead of holding on to the cash if you are in that sort of position. And then, as mentioned, investing in your talent workforce program to differentiate and grow. The market is contracting, unfortunately, in California, declining birth rates, people moving out of the state. So we have nearly the same number of schools, all competing for a shrinking pot of students. So making sure that you are telling that story and investing in the program.
Add some into that. So I think it's extremely important that you have a back office that is able to look ahead and provide you financial direction rather than just do your budgets for you and present to your board. I know back offices are getting better and better at this forward thinking kind of mindset, but not all of them do this. So I think it's critical for you, especially if you're in a stage in your organization where you want to grow either now or in the future, or you have large reserves that the money is just sitting there and it's not doing anything else for you. So I think a couple critical things around that, besides making sure you have a great fit with your back office, and obviously, we use them to our impact, and they've been, as Jason's saying, a great kind of director for us in terms of our mindset, but also a municipal advisor, someone who has an obligation to provide you financial advice and kind of aligning what your back office is saying your current state is with someone who understands the market as well. I'm going to plug someone because it's someone I've known for a long time and they do great work for us. Carl Yoder, who's here at the conference, he has a booth, I think like in the 1500 row. But Carl is truly an OG in charter school world, been around forever, was a founder of DMS, which is a back office provider. He's on our board now. But combined with advice from him and him being around for so long and seeing the ebbs and flows in the market, with the advice that our back office gives, it's really helped us completely change our mindset about how we manage our funds. And one more thing to add to this too is, let's say you have $10 million in reserves. So you have a lot of wiggle room based on your cash availability. Don't get too excited about 3-4 years in a row of deficit spending, even if your authorizer says it's cool, because you're buying all these things that you feel are really well aligned to your program. Because at some point you're going up for a renewal. If you show all these consecutive years of deficit spending, you don't know what the authorizing board is going to think. You may have gotten a sign off in writing or whatever the case may be from the staff you work with consistently, but then the board sees this presentation and they see, well, you got 3 or 4 years of deficit spending. They don't know what they're doing with their money. So I would advise, just as an operator and going through renewals and doing this for a while, kind of pick a spot, pick a year like, okay, this is what we're going to do. We're going to make a big move here. And if you have this longitudinal kind of pathway where you show really strong ending fund balances every single year, 1 year you deficit spent, it's easy to say, yeah, that's the year we bought our facility. That's the year we did X, Y, or Z. And then the rest of the years you're showing that you completely know what you're doing managing your funds. I think that's really important because, again, it's all about, I always say, it's always about the votes. It's always about sustainability. You need to survive. You need the votes from the authorizer. You never know who's going to be in that board when it's time to vote, that is your friend or not. So you kind of have to be that forward thinker to get out ahead of it. At the same time, using your money for the things you feel are best for your program and for your community.
It's just, yeah,
On, all of our clients use back office providers and a couple of them charter them back. And I know they've been able to find them revenue streams and other things, because you're busy doing your day-to-day operation of your school. They know some other things you might not be aware of. It's important to have somebody else on your side looking out for you.
yeah. I always say I'm a jack of all, master of none. I mean, I'm much more a master of like revenues and complexity and compliance, but we have a retirement team that is the expert on STRS and PERS reporting in your 403B and all of those sort of things. I can't imagine being a single person that has to handle all of those nuances of each department, and part of it being the back office model of fractionally tasking it. So each department can be the expert of their own world, but. Down, they go to hiring, they'll do that.
So continuing on, one of the things I wanted to, back up and talk about, we had a client years ago that they were doing construction on a building and they had all these extra funds. They had to keep the funds in a checking account, couldn't invest it. So we came up with a plan where we were able to donate to that school based on the balances that they maintain. So there's a lot of different things you can do even when the regulations cause you that. So as Jason said, some of the things you need to do is anticipate and plan. You're conducting your annual cash flow forecasting. It's something you need to do every year, and you need to evaluate it throughout the year to make sure that you're on target to reach that. If something's not there, then you're going to need to step back, see what you need to change to get there. And if you're achieving ahead of it, maybe it gives you some extra money that you can allocate to something else. Just talked about, diversifying revenue streams where there are other, in addition to earning money on your funds, there's also other revenue streams that might be available, grants and other things that back office or your people might be aware of that you can look into. Government makes them out, puts them out there, you might as well take advantage of them. School. And as Jason's talked about, you're building your emergency fund for unexpected things, but who knows what's ahead. We didn't know when pearls were gonna happen, but if you weren't ready for that, it can take you, for example, if you're gonna set up a line of credit, it can take you 4 to 6 weeks to get a line of credit set up, but you need the money sooner. It's good to have that planned ahead of time. Part of what I talked about at the beginning was the leveraging your banking relationship. So if you just know the people that you open an account with at the branch, schools your size should have a relation. There should be a commercial loan group for the manager and the lenders in that group are managing your account. One, they provide a higher level of service, but they provide all the services that the bank has for you, whether it's higher level online banking, so you can have all people in your school working on something, whether it's credit lines or real estate, or if you're buying equipment, you can spread the cost of that equipment 3 to 5 years instead of paying it all up front. There's a lot of things with by having that higher level banking relationship. So if you're just working with the people at the branch that you open the account with, you should expand that relationship with your bank. Just ask for that. They'll be glad to provide it for you and benefit your school greatly.
Who here has a line of credit? Does anyone? I think, it's a newer factor, right? Like we go 5+ years ago, your only option was to sell receivables, and there's really 2 key players in the game for selling receivables. Now, banks with like Omni with the specialty department understand how apportionments work, how the state, if your program's growing, how they're underfunding your school. until you get to P1 and they start paying on the current year's attendance. And then your biggest payment is often your P2 true up that doesn't come until, that first week of July or so. And so you have to fund that growth. So a bank like Hanmi is happy to set up a line of credit to fund that growth and at a much reasonable rate than you're paying on selling receivables. So good alternatives here.
And you can, again, that's leveraging your banking relationship. If you have a lot of deposits, you can generally get that line of credit for a lower rate and little or no fees, and have it in place even if you don't use it. You only pay if you use it. Good thing to have in place, and it's another part of leveraging that banking relationship. And another thing, like a lot of our clients do, is they set up a fairly substantial credit card line that uses a portion of that credit line availability, and then they can earn points and benefits and delays in spending, gives you sometimes about a month or a month and a half of delay on when you have to pay those expenses. So again, that helps your budget and cash flow as well.
I guess one of the other, I think, key questions here is raise your hand if you can name like your banking rep. Like that's probably, if you don't have someone, a direct line, if you're calling a 1-800 number, then you probably are being underserved within your banking relationship. If you don't have like an assigned rep that understands what you're doing and is there bringing products to you that will be useful. And so food for thought on that.
I agree with this 1000%. I don't think I realized as an operator how important that was. The thing is, we have built-in leverage with just the nature of our business. Even with deferrals, there's, for the most part, guaranteed funding if you've got kids. So the larger your school, more leverage you have. And if that bank is not providing you, as Jason said, someone who can accommodate your needs and understands kind of how the inner workings of a charter school impact day-to-day finances, you are 100% being underserved. I'm not going to sugarcoat that. Also, that rep or reps should be coming to your school sites. They should take an interest in what it is you're doing. If they don't forward that conversation with you, you should drive that and get them there, because the more they see what you're doing and understand the impact you're making in the community, the more that you will be top of mind when different opportunities arise. It could be, short-term money market opportunities. It could be whatever it may be. But you have the potential to have that money that you have in the bank earning more money for you to do more things. And sometimes the rates are actually really favorable. So in 6 months, you could be earning hundreds of thousands of dollars of money that you have just sitting there doing nothing by itself. Well, hundreds of thousands of dollars at the end of the year could be the difference in 1 or 2 teachers that you're keeping, or a support staff member that is critical to your operation. Those things make a difference. So I felt like, to be honest with you, we had years of wasted opportunity because we didn't really dive into this option of ensuring that we had money working for us. But half of that was I didn't do my job of nurturing that relationship with our banking partners.
Some of those banks sometimes are taking advantage of it. We've come across some prospects where they're getting paid 0.02% on tens of millions of dollars. You would have thought that banker would have called them up and said, "Hey, I realize you've got this much money and you're only earning 0.02%. We've got this great CD or this great product." I mean, that person should be an advocate for you, not just, "Hey, let's keep quiet for as long as we can and pay them 0.02% until they complain about it." The other thing is, if you're paying fees on your bank account, balances that the schools maintain, they really shouldn't be paying any fees. They should be able to cover all those costs and have access to invest. And one of the things that we always do when we bring in somebody new is we evaluate that, show them, here's how much you need to cover your day-to-day fees, your online banking, your wire, all those things. And here's how much then you could invest up to this, and the board would determine what level they want to invest in. We may tell you that you could invest 85% of it, but I don't think we might pick a lower number that they're going to invest, but they can at least get an idea from their banker what's available to do that with.
I had one more thing before you go on. I think, Jason, you touched on a spending or reserve policy. And I think it's really critical that your authorizer signs off on it. And you may have more than one authorizer. We have 3 different authorizers, one of them being LAUSD, who's our most stringent. And so it was critical for us to, number one, make sure that we can invest our money, obviously in a very safe fashion or minimal risk. But also we drafted the policy and we made sure that they signed off on it. So the last thing you want to do is engage in this whole process. You have a policy, you're all excited to now, make some money for your organization. And then your authorizer is like, wait, you can't do that. You're not allowed to do that. That's the last thing you want. So it's really critical, in my opinion, to make sure you have the thumbs up in writing from your authorizer. And if you have more than one, you're gonna have to do that work for all of them. And some of them may be more like, no problem, that's what we would expect you to do. Others might say, no, you shouldn't be doing that, or this is how we want you to do it. So I would just say, it will come up at some point, either an annual, your annual oversight visit, or just in the process of doing business. If that is really, if that relationship that you have with your authorizer in the policy development is not crystal clear.
But this is all legal process, right? I mean, you're not doing something crazy where an authorizer would say, this isn't illegal. It would just be their preference that you did, kept it all on their fund or whatever.
Yeah, so Jason's touching on like reserve, that you can also within your reserve policy have an investment policy. So in scholarship prep's investment policy, it's like, everything will be FDIC insured. No, nothing is going to be in a risky investment. Yeah, this should all be above board. But establishing like the way that you see fit to invest and making sure it's in alignment with the district or authorizer. That relationship's just so important, right? Especially with everything going on now, schools getting denied their renewal after, no one had to do a renewal for almost 5 years now, being back on that track of like going through the scrutiny and making sure that your program doesn't get shut down because your relationship has faltered with that authorizer.
And one example of risk that really is not about money that can be lost is, let's say that you, for whatever reason, took 100% of your cash reserve, you put it into like a 6-month CD or something, where you can't access your money during this period of time. To me, that's a gigantic risk because you don't know what's going to happen in that 6-month period of time. I don't think anybody would do this, but that would be an example of something that maybe is not explicit in a policy, but you'd want to make sure that that transaction is something that you're clearing with your authorizer. Because they may feel like, hey, you can do whatever, but you should still maintain X amount of cash on hand in terms of number of days or months beyond whatever you're going to invest, because you can't have this money you can't access during that period of time.
Yeah, and on that, another good example, separate from like CDs where typically you can pull the money out, you just wouldn't have earned any interest on it, is like treasury notes, which is with the federal government. But if everyone remembers Silicon Valley, that's why the bank went under. They invested in treasury notes, treasury bills that the value of that fluctuates with the market. So they needed to tap into cash by selling some of those treasury notes. Well, they bought those treasury notes at 2%, and now the market rate is 4%. So there's a discount rate on the treasury notes, and they lost all this money on it. So part of it is establishing like the risk tolerance, and you can earn 4% on your money, and there's no pat on the back from the authorizer, but you lose $100 of the principal investment, and they're going to come after you. That is public money. You need to make sure that you're investing in a way that you cannot lose any of the principal.
Speaking of Silicon Valley, when that happened, it created quite the stir. We already had a product at the time in CDs, where the CDs were protected basically with these programs, ICS interfi sweep account. What that basically does is it takes your money. If you have $1 million, you're gonna get 250,000 of FDIC coverage. It takes the other 750,000, divides it for 3 or 4 banks. So in the back, you just run your normal checking account. If you need funds out of the other banks, it just pulls it automatically each day. But it gives that company or the school 100% FDIC coverage. So that suddenly became popular. Now there's a cost for the bank to get that. It's not free. And so generally what they do is maybe give a little bit less on earnings credit, or a little bit less on their money market rate. If you were to put all your money in the money market rate, just kept it at Omni Bank, we would probably pay 25 basis points higher than we might if you put it all in the ICS. But certainly for your board and all of our schools, every one of our schools chose the ICS, both the checking and the money market. Jason said, protect that principal at all costs. And it's hard to raise and earn that money. Don't want to give it up just to make a couple extra percent. Fraction of percent. It's a risk that probably not worth taking. Like, I think I attended something yesterday where they're talking about potentially investing in mutual funds, and it just on the 401k knows what happened the past few days on those. It's not something you want to tell your school board. Guess what happened to our fund? So obviously the ICS, now different things they have to make, like when the client, that one client was trying to protect everything, they had layered CDs that matured every week. Well, that was a lot of work for both the company and the bank. We went to them and said, hey, we'll just give you a similar rate on the money market as you're getting on these CDs, move it all into the money market. And to me, the money market has a slight restriction. You can withdraw 6 times a month. I don't know why the banking industry set that figure, but that basically gives you once a week on expense runs and then 2 extra times a month that you could put out. Whereas if you had a CD, you would have to break the CD and you'd lose a chunk of your interest. So if you had a 3-month CD and you broke it, half your 3 months interest would go away. So probably not, again, you have to weigh that. You're going to lock up money in the CD versus the money market. I'll check if there's the same ICS program for a CD, but the access to the cash on a short-term basis, money market account is superior.
How many people here have over 250,000 in their checking or savings account for the school? And how many here use an ICS product so it's fully insured? It's just food for thought on it. Even the biggest banks have had issues historically at some point in time. So getting that full backing from the government is nice. So that ICS product, it gives you that, I think it's up to 35 million. That
150 million.
Ignore me. Way more than 35.
Airport, 150 million.
Yeah. Sorry, question in the back?
Say, I know ICS product.
Yeah, so ICS is a sweep product. So let's say you invest $1 million into you give the bank $1 million. In the background, it all shows up in that checking or savings account. In the background, the bank gives, so Omni Bank gives Wells Fargo 250,000 and gives Bank of America 250,000. You don't actually, it all shows up in your checking account with Omni, but they are behind the scenes giving a portion to multiple banks. So you get FDIC insurance to the full up to $150 million.
And effectively, they're sending us money back. So we all have the same amount. We all have the same amount of money, but in the background, that's happening for you to protect your money.
Yeah, another question?
I guess it's just not one of the estimates, right? At the end of the day.
Sorry, you're asking if they're in the background investing the money that you're giving in? Yeah, so they're investing it like any bank would invest the money. They're giving out auto loans and mortgages and everything like that, but they're not investing it like in the stock market or something risky. The bank is using it as though it's their normal extra cash that they have from any other deposit relationship. But yeah, it's not as though if you give them $3, they're now with this ICS program, investing in risky investments, and you might not be able to touch it. It's like the bank has $1 million, just like any other relationship. But if the bank faltered, you would be fully insured on that $1 million. Whereas if you just have a standard checking or savings account, the government in theory would only cover the first $250,000 of it.
Yeah, so the companies that had money at Silicon Valley Bank, that only had their money in Silicon Valley Bank, they were only covered for 250. So that prompted, when that happened, it prompted everybody to start thinking about it. But clearly from Jason's question, a lot of people in this room have not done that. That's something you should go to your bank and talk to the board about. Protect your money. It's just a prudent thing to do. Obviously, a bank as strong as Omni Bank, we don't expect to have anything. And we have prudent loan policies and everything to protect everything. But product is now available, it's readily available, and it's obviously,
Did anyone else have any other questions about ICS? Does that make sense? Is that like a good basic foundation that now you can take to your bank representative and be like, hey, I heard about this ICS product. Does XYZ Bank offer this? And most do. And then it's also a question of, if they do offer it, why didn't your rep talk to you about it? Or, why are they not proactively bringing this to your attention? Just like Ben was saying, Hamdi is not expecting to have any sort of issues or falters, but, you can never have enough safeguards in anything, right? So I don't think any of us are planning on having anything go wrong, but things do go wrong, right? So having those extra safety nets, it doesn't hurt, especially if it's not coming at a cost to you, and the product is readily available. Some banks don't offer it. Like Wells Fargo doesn't offer it. Like those super large banks, sometimes they just say we're too big to fail and we don't offer this product. But yeah, Carrie?
So my question is, with the ICS, can you also get like the money market at 3.8%? Okay, I
100%.
missed if you said that. Okay.
Yeah, so you can get ICS products on money market, checking account, CDs. They are offered on all of those sort of products.
yeah, like I said, there was a cost. So for example, if you kept our highest rate we're offering for a large account right now, let's say it's 3.85%. If you kept all your money at Mommy, if you put it in ICS, it might be 25 basis points less at 3.6. There's a difference, but that difference, you're purchasing that safety, that effect, where you might be able to earn more by leaving it all in that thing.
And going back to Jason Watts' is a point of like, they have an investment policy. If your investment policy states that it's going to be 100% FDIC insured, this is a very easy way to accomplish that without having to open 20 checking account, 20 savings accounts at 20 different banks and putting $250,000 into 20 different places and trying to manage that.
Yeah, that
So-
doesn't sound fun.
Right.
For a CFO or for anybody. So the third item on this slide, long-term sustainability, that's some of the things where you're making long-term investments. And a lot, some of our clients, whether it's a commercial client or the school clients, have elected to eliminate the landlord and purchase their property. One enables them to either design, keep the property the way they want it, and it locks in when you lock in a long-term rate on the loan, it locks in your rental rate, whereas your landlord may be raising it every year. So if you have excess cash and could potentially invest in a school property, there's lots of ways to do that. And Jason, I guess, send you in that direction. Do that. So to go back over this, the final things are, you're going to assess your financial resilience with your regular reviewing your cash flow reserves and risk options. You're going to look to set policies that align with your long-term goals. Going to make strategic investments, whether that's in money market accounts or in long-term things, and then you're going to plan for the unexpected. We want to leave a couple minutes here for questions. I'll sped through the last slide to open up to any more questions anybody wants to ask about anything. And I'm down in booth 631. If anybody wants to come talk to me later today, 631, or you can come get my card up here and contact me outside the conference at any time. Any questions anybody have? Please raise your hand or we can bring the mic to you.
When you first stepped up, you mentioned that you had solved a problem by donating money from one institution to another. Can you,
It was to the school. So the school was built, school had they obtained the bond financing to build their new school building. They had 20 million sitting in our checking account and they were not allowed to move it to a money market. And it was gonna take between 12 and 18 months to spend that $20 million. So what we did is we went to them and said, hey, what we can do for you, since you can't move it to a money market account, we'll pay you. At the time, rates are pretty lower. We were giving them a certain amount of basis points against that average balance in the checking account, and we just donated it as a charitable donation to the school. But our bank, and we would be willing to do that for somebody that has that kind of situation again. Because it helped the school and it benefited the bank because we had a nice checking.
have you worked with schools that have like a foundation, say like a nonprofit foundation that operates for the purpose of benefiting the school? And working with say the foundation owns the assets of the school and the school rents from the foundation or from the nonprofit? Have you worked with anybody doing that kind of thing?
Yes, in fact, that donation went to us. It didn't go directly to the school. They had a foundation where those funds went to. That's where our donation went. We asked them where they wanted it to go. Any other questions? Any other comments you want to add, Jason or Jason Square?
Yeah, I think the only other thing I would say is we've kind of touched on it indirectly, but don't be afraid to negotiate with your current bank. I'll give you an example. We have a foundation actually. It does not own any of our properties. It's specific to filling the gaps of our program where we can't spend public funds. And we had a bank that we were using. We wanted them to be more involved with the foundation work. They were kind of non-responsive. And so I said, hey, to our rep, I just drove by this other bank. They got a really nice building. It looks really nice. I think I'm gonna go in there tomorrow and talk to some folks. Well, one of two things was gonna happen. They're gonna either respond to me or they weren't to my satisfaction. Well, unfortunately, the latter happened. And we switched banks. Then all of a sudden, oh, you're pulling your money out, or you're closing your account. Oh man, how can we, fix this? I'm like, you had a chance. So in that respect, I wasn't afraid to rip the Band-Aid off. But with the bigger banks, because these were smaller banks, they're probably not going to let you do that without a fight, which is good. That's what you want. Don't be afraid to negotiate and tell them, hey, I'm starting to talk to these other folks. They're willing to come out to our school and help, donate their time at some of our events. And, what are you guys going to do? Most of the time, especially if it's a bigger bank, they'll have plenty of reps that can work with you. They will probably bend over backwards for you. So negotiate.
You're a valuable client to your bank, and you should, if you're a really, really big bank, sometimes like the one that was giving 0.02%, you're not that important of a client to a bank that size. So sometimes you want to leverage to a medium-sized bank where you're going to be a very important client to that bank, and you're going to also get assigned a very experienced person. Like those big banks might assign you somebody that's very new to banking versus somebody who's more experienced. But you can leverage. That's one of the things you can leverage your banking relationship because you're about look in the mirror and say, you're a valuable client for these banks. Trust me, we're here. We would love to have many more clients. My board of directors is saying, go get some more charter schools. And because you're a valuable client to the banking industry, you should take advantage of that.